Let me get your opinion here. What's going to happen this week? Does the Fed move or not?
I think Joe nailed it. They'll probably change the language. There's very low market expectations here. They can fall back on the fact that maybe the CPI is running hot, but the personal consumption expenditure number they look at is not. They have a little bit further to go to achieve full employment. But with regard to the financials, one of the problems of the policy they've pursued is that they've been gutting the financial institutions. With the banks, the net interest margins are nil. Insurance companies, and of course state pension funds, other forms of savings formats, are really beginning to feel threatened and are in need of some relief. Having said all that, I do expect them to continue to emphasize the fact they're going to reinvest the system open market account portfolio. They have $1.1 trillion maturing between 2016 and 2019. And where they invest along the yield curve, as Janet Yellen said in her speech to the Economic Club of New York, is really how they achieve monetary accommodation. So I think there's too much focus on a quarter point in September, a quarter point in December, most likely. But the real key to monetary accommodation is what do they do when they roll over that portfolio and reinvest? And the fact they have 35% of all U.S. Treasuries beyond a 5-year maturity, they've got a lot to play with.
Maybe, Richard, they need to rethink the whole thing. As former Fed Chair Ben Bernanke wrote in his most recent blog, maybe, as he said, you can't go home again. Maybe they need to rethink the entire exit strategy.
Well, I think the Japanese have come to realize this. We saw some news over the weekend at their last meeting and discussion. They were talking about how much damage they had done to the insurance companies and the banks. We saw an article in Handelsblatt, the big German newspaper, last week about the threat to their insurance industry here. These are the savings media that most of the people, 90% in the case of the United States, that have some money in the bank, look to, and for financial security. So on the one hand, I think they're looking at the wrong place, by the way, at the FOMC, the Federal Market Committee. They have their blinders on, focused on those two key criteria: employment, inflation/deflation.
But let's be clear, Richard. If you were in the room this week, I hear you saying that you would vote not to raise rates, even by a quarter point at this meeting.
No, I would advocate raising rates. I don't think it does much damage to the economy, and it also gives breathing room to those key financial institutions that we need to be prosperous. Now, I don't think they'll do it, but I would have argued this quite a bit because, as Eric Rosengren from the Federal Reserve Bank of Boston, quite a dovish character, but a good man, he's beginning to talk about the fact that we have sustained this financial bubble. But there's also this other aspect, gutting the basic financial infrastructure of our country. That's a byproduct of zero interest rates and certainly of negative interest rates in the case of Japan and Germany and elsewhere. It doesn't work.
What the Fed may do and how the markets may react based on what they do. Joe, what do you expect this week? As an investor, how do you play it?
I expect hawkish language. That's what I expect. And I think some of the rise in financials in the last couple of weeks, whether you want to stay with the financials or not, we'll get into that in a minute. But I think some of the appreciation is attributable to the fact that we expect the Federal Reserve not to do anything at this meeting, but to talk about what they are going to do and indicate to the markets that they will be doing something in December. Let me also just say, I think it was very surprising last night when you turned on the screen at 6 o'clock and you saw the S&P 8 handles higher. I think that's just indicative of the environment that's so difficult to understand right now.
You would have expected or understood. I guess you're saying if the market would have had a more negative view of what happened over the weekend in the tri-state area.
Especially given the price action last week and where we went out on Friday. It was an ugly day.
So, Kevin O'Leary, I know you're with us from L.A. Thanks for being here today. What do you expect? What are you doing in advance of what the Fed may or may not do come middle of the week?
So I'm trimming financials. I kind of agree with Joe. This will be if we don't get, I assume no rate hike in September, but I think baked in is 25 basis points in December. If that doesn't appear, it'll be the 5th head fake in this cycle. And those that are long with the anticipation that it's finally time for financials to perform are going to lose 4 to 10%, just like they did 4 times in a row. It may just be that we're in a perpetual low interest rate environment, and this is a sector that's just going to continue to fibrillate between the optimism of a Fed hike at some point before you die and the fact that it never comes. It's a nasty little sector. I wouldn't be long here. You could really lose some money.
Yeah, there's some interesting trades to think about, Jim, when you look at what the Fed may or may not do, and financials have been kind of the place to be if you thought rates were going to go up, and maybe now's the time to worry about that trade in case they don't move at all.
Well, I think if you're in financials because you're expecting a rate hike on Wednesday, you've got the wrong trade on. I don't completely agree with Kevin. I do think that financials have had a very nice run off of the February lows, and they may have a little more in them. I just don't think that anybody right now is pricing in a rate hike on Wednesday. So if it doesn't happen, I'm not sure I see that 4% sell-off in the XLF.
That voice you heard trying to get in on the conversation was Kevin O'Leary. From Shark Tank, of course, our resident shark, who says the market's ready for a hike. I know you say they're not. Maybe you guys can duke it out by satellite.
Well, I wanted to ask Richard. He uses the words gutting the institutions, but I look at it not just on the fact they can't make money with the interest rates where they're at, but we don't talk enough about the regulatory environment, which is extremely punitive. Extremely punitive.
It's a pincer movement. It's a pincer movement. Policy's killing these institutions. And the regulatory environment has gone to be a little bit too harsh, and it's very hard for these institutions now to live the kind of lives they're used to. And remember, this is where your two middle-income quartiles, hardworking men and women in this country, the muscle and fiber of our country, not the richest, not the very poorest, but this is where they look to harbor their savings and feel safe, and we're gutting those institutions.
So then, Surratt, the guy's got to put money to work. All of the AUM that you have, what do you do when you listen to the comments from both Richard Fisher and Kevin O'Leary?
So I look at it and I agree. I think the Fed's going to say, hey, listen, at this point, let's not do it now. But what I would be interested to ask the question is, do you think that maybe after the elections they could go? They don't have to wait till December, but you have that period of time where you indicate now, you become hawkish, like Joe said, and then you can do it and then kind of set the tone from there.
Does anybody on the desk think they're going to go?
No.
So if they do, you'd be totally caught by surprise.
Yeah. Well, more importantly, I think the market's going to be totally caught by surprise, and everything in that environment is going down.
Right.
Bonds, commodities.
I think that would be the best thing that could happen. Is they do it, they reassert themselves, they stop talking about it afterward. We have a 10% correction, and then we set up a run into year end when everyone realizes the planes aren't dropping out of the sky. I don't think they'll do it. I hope they do.
Richard, do you think the Fed is too dependent on how the market reacts or what the market wants the Fed to do? That's been the narrative. That's been the narrative for months.
I think you have it reversed. The market is too dependent on the Fed. We don't have strong earnings. We have modest growth, economic growth, but it's Fed, central bank, central bank, central bank.
Agree.
This is the problem. So these low rates and zero interest rates and negative interest rates and NIRP have underwritten a massive pricing of the market relative to underlying value, and I think it's the other way around, not the way you stated it. The real issue for the Fed is the following. If we have enormous volatility in the marketplace and we have a significant correction, you mentioned 10%, I've heard others talk about 20 to 30%. Does it infect the real economy? We had a correction in 1962, no real impact. We had a correction in 87, no real impact. We had a correction in .com, no real impact. But we've had serious reversals. 37, for example, is a year you always hear about. The horror we went through in 8 and 9. So if it infects the real economy and sets back the functioning of the real economy, that would be a negative outcome. And this is a debate that takes place at the table. You can have a correction that doesn't do much harm. You can have a correction that does an enormous amount of harm. And that's a judgment call that they're going to have to make.
Richard, how many people in the room need to be dissenters, if you will, or against the crowd for the Fed chair herself to not make the move? You're going to get people in the room this week who say they should do it. We should do this, guys, gals.
Well, right now you have Esther George, who's openly dissenting.
Brainerd wouldn't do it, right? Is she a voting member?
She's always a voting member. She's a governor. The governor's a voting member, the president's alternate.
She's not going to go for a hike. So how many would it take?
Well, typically, other than when Paul Volcker was there, the recent chairs have really sort of gagged at 3. 2 is all they'll tolerate. And if it gets to 3, it's very awkward for the chair. It undermines their position of authority and leadership. So I don't think any chair really wants to have 3 dissents, but I can't imagine they're having 3 dissenters on this vote to increase by 25 basis points.
The markets have lost, I don't know, half their gains since we began this conversation, Richard.
I'm not responsible. It's the rest of the panel. And you.
I don't know.
We'll send you a bill.
Maybe the suggestion that the language is going to change, if nothing else, and it's going to set us up for a hike this year that the market perhaps doesn't like and is never going to come to grips with.
By the way, I don't think they would do an interim move between the November 1 and 2 meeting and the December meeting. That would, imagine if they called a sudden press conference. It just would be upsetting and lead to great volatility. So you really have to wait till the December meeting if they don't move in September, and we'll just have to see what obtains.